Top three things in my notebook this morning. Number one, the 10-year bond yield here in the U.S. Number two, the price of gold. And number three, all of Europe. So first on the 10-year bond yield, we put this up as the chart of the day. We actually had it up on the website on Friday. Easily one of the more epic moves I've seen wire to wire on a 2-hour basis in the 10-year bond yield coming out of any kind of a jobs report or an economic report for that matter. Going back at least a couple years. I mean, look at this baby. As soon as the headline was quote unquote good, you saw different people go, boom, yeah, ooh, ah. I mean, I was like, what is going on out there? I mean, it's like somebody at one point said, goodbye bond market. Intraday, the bond market hit a fresh year-to-date high. So again, look at this for what it is. Markets are forward-looking. An economic report, particularly the unemployment rate, is what we call a lagging economic indicator. So again, the 10-year bond yield and the dollar together, we continue to think is signaling the nasty. In other words, U.S. growth is going to continue to surprise on the downside. And when growth surprises, the 10-year bond yield goes down and bonds go up. So that's point number one. Point number two, gold absolutely loves yields falling. So again, as you know, the price of gold for the year to date is up, 8%. So if you're long that, you're pretty happy. And again, you're going to be happier this morning because it's up another full percent. So why would you bang your head against the wall trying to buy the Russell 2000 or Facebook or whatever it is when you can get that kind of a return? So again, people tend to whine about gold on down days. All we say is buy the darn thing. And at the end of the day, it's because we fundamentally believe growth will slow as inflation accelerates. So again, a breakout line in gold is 1291 on our immediate-term trade momentum line, if you're keeping track. And then finally, Europe, which had another good week last week. Don't forget that European equities, as opposed to being down 3% for the year to date, like the Russell 2000, the Euro Stock 600 is up a full 3% for the year to date. So again, Europe has looked good, but again, it is correcting right now. And I do think that that brings on a lot of interconnected risks that is associated with what? With the U.S. growth slowing. And again, I think that that is what people are going to have to come to realize as we go through May. And again, we don't want you to buy in May and pray. Stay with the playbook that we've had, which is of course being long inflation and what it gives you, which is slower growth. So those are your top three things.